Hi, I'm Mark Farber, and this is Accounting Fundamentals. So, in this series of videos, we've gone through the process of identifying transactions for a company, journalizing them, posting them from the journal into the ledger accounts, and creating a trial balance to make sure that everything looked okay. We then, in order to follow the rules of accrual accounting, did a whole bunch of adjusting entries. We looked at supplies, we looked at prepaid expenses, we looked at depreciation, and various accruals. And for each one of those, we entered a journal entry. Each one of those journal entries would then get posted into the appropriate ledger balances, or T accounts, in order to update the amount in each one of those accounts. So now we're ready to produce the financial statements. But before we do that, we prepare what's called an adjusted trial balance. Remember last time when we did a trial balance, we listed off the accounts that were in use, always in the same order: assets, liabilities, equity, revenue, and then expenses. And we've got the account balances, and I've just put in some balances for each of these. We've got the account balances for each. Again, remember, asset accounts are going to be a debit balance, liabilities are credit balance, capital or equity will be a credit balance. Withdrawals is a contra account, meaning that it works in the opposite direction or it reduces equity. Revenue is a credit balance, and our expense accounts are all debit balances. So we're ready to produce the financial statements. And the three statements that we're going to produce are going to be the income statement, the statement of owner's equity, and the balance sheet. And they get prepared always, always, always in that order, and you'll see why. So let's go through and do them. First, we'll do the income statement. As I said before, we always start off with company name. I don't know what the company's name is, so I'll just put that in. And then we put income statement. And then the date. And the date for an income statement, because an income statement shows us what happened over a period of time, we have to put what that period of time is. I'm going to assume that this was over the course of a year. And so I'm going to write year ended December 31, 20X1, or whatever that year might have been. Okay, if it was monthly income statement, I would write month ended. Or I could write January 1st to December 31st, 20X1. But I have to convey that this occurred over a period of time. And then all I'm going to do for my income statement, quite frankly, is I'm going to take this information off of the adjusted trial balance. So we'll start off with revenue. And notice that on my income statement, there's no debits and credits. It drives me crazy when students put debits and credits on income statements. We can put debits and credits on a trial balance because that's for accountants to look at or finance people to look at, so we know what that means. But income statements and other financial statements are for the general population, and they don't necessarily know what debits and credits means. So even though we might have multiple columns, the columns are not representing debits and credits, they're just to make things easier to read. So revenue, $20,000, we'll put that in. Then we have our expenses. So I'll write expenses. We could report the entire value of the expenses, which is $17,000, or we can list them off. I'm going to list them off. So we have salary, $10,000. And notice it's really just a copying exercise. $6,000 for rent, and other expenses, $1,000. We normally take a subtotal, so that's $17,000 in total expenses. And then the one calculation we have to do on the income statement is we're going to calculate net profit. And net profit is just going to be our revenue minus all the expenses, which in this case is $3,000. And there you have it. That's a perfectly good income statement for this company. So that's the first statement that we have to do. Now the second statement that we're going to do is the statement of owner's equity. So let's do that one up here. Pick green for that. Again, company name, statement of owner's equity or owner's capital, and the date. And again, this is going to be a statement that covers a period of time. So it should be the exact same period of time as the income statement. Year ended December 31, 20X1, whatever year that would be. And this one's going to take the form of a flow statement. So we're going to have opening equity. And normally we would put, excuse me, we would normally put the date. I'm not going to, just because I'm constrained again by space. But the opening equity, meaning at the beginning of this period, on January 1st, 20X1, how much equity did this company have? And I'm going to assume that the company had $8,000 of equity. This number here. Again, we're working with this part of the statement. It could have had 0 and there could have been investments, as we'll see in a second. But I'm going to put in that there was $8,000 in this case. And then we're going to add investments. So did the owner invest any money in the business during this period? Well, it doesn't show us any, so I'm going to say no. We normally take a subtotal here, $8,000. And then we're going to subtract, so less, let me just do that, less withdrawals. So remember, our owner's equity was equal to 4 things, going back to the very first video where we talked about the accounting equation. It was investments plus revenue minus expenses, which we're going to get to in a minute, minus withdrawals. So in this case, the owner withdrew $1,000. And I'm going to add in, normally this would have been done maybe on top, but we can do it here. I'm going to add in profit. And I'm leaving it till the end, only because it's the one that comes from here. And it's simply this number that we calculated, we're going to insert. So we're going to get an ending balance. And the ending balance is going to be the $8,000 minus the $1,000 of withdrawals plus $3,000 of profit. That's going to be $10,000. So at the end of the year, this company now has $10,000 of owner's equity. And this statement's kind of nice because it tells us they started the year with $8,000. They made no new investments. The owner withdrew $1,000 and he earned $3,000 during the period. And so at the end of the period, the equity is growing to $10,000. In our next video, what we're going to do is we're going to continue building financial statements. We're going to build the balance sheet, and that'll be the end of the financial statements for us.